So welcome to synchronous session 6. It's hard to believe that we're at the end of our third week in the course, but we are. Okay, so we have a lot of material to cover with the review and a few things that that we didn't go over together on Tuesday. So I'm going to go ahead and start. All right, so question number 1, given sales and cost of goods sold, calculate the gross margin. So this one isn't hard. I do need a pen, however. The gross margin is just the way the new income statement is when you have inventory, which is just you're going to take sales minus cost of goods sold, and that gives you your gross margin, or sometimes you'll hear it called gross profit. All right, good there? Okay. Number 2, we want to do a journal entry for making a payment. So a company purchased $4,000. I know I'm going to need a T account because I see that they purchased and they returned. So I'm going to do a T account just like we did with the practice problems. As soon as I locate my missing mouse. Do you even know how to find your mouse when it's missing? Ah, got it. It's like control something. That was really weird. Okay, so I'm going to go ahead and start a T account. So I know that we're dealing with accounts payable. Okay, so a company purchased, sorry, I'm still admitting people. Okay, so a company purchased $4,000 of merchandise on July 5th. So we purchased $4,000 with credit terms 210 net 30. So we know we get a 2% discount if paid within 10 days. On July 7th, it returned $750 worth of merchandise. So that we're not going to have to pay for because we've returned it. On July 12th, it paid the full amount due. So we can see that we have $32.50 is our balance right now. All right, so we get a 2% discount. So we know that we're going to have to pay $3,250 times 98%, or we're going to pay $3,185. That's what our check is going to be written for. And our discount is going to be 2%. So times 2%, our discount is $65. All right, so then when we put together our journal entry, we think about, well, what do we know? And one of the things that we know is we know that when we're done, we're not going to owe anything to this company. So we know that we're going to debit accounts payable for the whole $32.50 because we're not going to pay any more later. We're the one that purchased. So remember that you have to realize, you have to figure out, am I the one that's purchasing or am I the one that's selling? So we're the one that's purchasing inventory. So we know that we're going to write the check for $3,185. And so the discount, because it's our inventory that we purchased, is going to come out of inventory. We're going to reduce inventory for $65 because we're the purchaser. All right. Are we good there? Mm-hmm.
So for the, so this is off of perpetual. I see it now on the third line. Okay. If it's periodic, it would be purchase discount, right?
Yes. No. If it was periodic, it would be purchases. Oh, wait.
Oh, the discount I'm talking about.
No, what you're thinking about is if we're the seller, then we're going to record discount.
Got it.
But if we're the purchaser and we're buying the inventory, then we don't. Then we just increase or decrease inventory. That's why I said this is one of those chapters that's challenging because you have to constantly think, which hat do I have on? Do I have on the hat where I'm buying the inventory for my company to resell, or do I wear the hat where I'm the person that is, you know, buying the end product user?
Got it.
Okay, so next. We want to figure out the total cost of the merchandise. So a company purchased $4,000 worth of merchandise. So obviously that $4,000 is going to be included, right? Transportation costs were an additional $500. Remember that with inventory, we include everything in inventory on our balance sheet that it costs to get the product to us and ready to sell. We returned $300 worth. So obviously we don't have that since we sent it back. And then we paid the invoice with a 1% cash discount. So let's go figure out what that means, because we know we have to reduce inventory for that too. So originally we purchased $4,000 and we returned $300. So our balance is $3,700. We're not worried about the payment right now. We just need to remove the discount amount from inventory. So the discount amount is 1%. So we get a $37 discount. So we're going to reduce inventory for the discount of $37. And when we do that, our inventory total right now is $4,163. When you do this one, remember that there's no discount on transportation. It's not part of accounts payable. Make sense?
Mm-hmm.
Yeah, so don't get mixed up and add that in there. All right, are we good here?
So transportation is part of cost of goods sold, but not part of the merchandise, total cost of merchandise?
No, okay, so transportation goes on the balance sheet under inventory. It's part of our inventory. Anything that it takes to get the inventory to us and ready to sell is part of inventory. Does that make sense?
Yes.
Okay, so that's why the transportation is included there. We're just trying to figure out on the balance sheet, what would our inventory look like? And our inventory would look like $4,163 right now. Okie dokie. Next. We're going to figure out, we're going to do a journal entry for one. I can see that. So on February 3rd, Smart Company sold merchandise in the amount of $6,000. So we sold it for $6,000. to Truman Company with credit terms 210 net 30. The cost of the items, it should be 4,000. The cost of the items sold is 4,000. Smart uses a perpetual inventory system and the gross method. Truman pays the invoice on February 8th and takes the appropriate discount. So we want to know, what is that journal entry? Okay, so everything, if we look at the we have $6,000 in our account receivable balance, and they didn't return anything. So that's all it is, $6,000. We're done figuring that out. So now we're going to figure out the discount and how much we're going to pay. So if we owe $6,000, or if they owe us $6,000, and they're going to pay us 98% of it because they get a 2% discount, that means we're going to open the mail and there's going to be a check for $5,880. It also means that the discount that they get for paying early is $120. So when we look at our journal entry and we start piecing that together, we know that we're going to receive cash because we're the one that sold. We're going to receive cash of $5,880. We know that we have to reduce accounts receivable by the full $6,000 because they're not going to pay us anymore. And so the discount, this $120, now, remember, now we are the buyer. Well, we bought the inventory, we're selling it to our customer, to the end user. So instead of reducing inventory or increasing inventory, we're going to record sales discounts. All right, do you feel good there? You're very quiet.
So cost of goods sold there for $4,000 is just there to mess with us?
Yes,
Okay.
totally. Yes, it is. Okay, question 5. We're going to do the journal entries to record a sale. And remember that in this case, there's 2 different entries. We have to, number 1, record sales revenue. That's not new. We've been doing that. And then number 2, we have to reduce inventory. And record cost of goods sold. So on September 12th, Vander Company sold merchandise in the amount of $8,000 to Jepson Company with credit terms 310 net 30, which we don't have to worry about yet. The cost of the items sold is $6,000. So we have $2,000 in profit. So to record this, the first thing we're going to do is record the sale. So we're going to have accounts receivable and sales revenue for $8,000. And then the second thing we have to do is take the inventory off of our books and record cost of goods sold. So our cost of goods sold is $6,000. And we're going to reduce inventory at our cost, obviously, for $6,000. So on the income statement, you're going to see sales revenue $8,000 and less cost of goods sold $6,000 gives you your gross profit of $2,000. Are we good?
I thought with the periodic system, you don't record cost of goods. Like with your merchandising.
Oh my gosh,
I thought that was only perpetual.
you're right.
That's why I.
No,
'cause
you're
we
right.
just- okay, I'm just making sure because I was like, I feel like I'm backwards here. I want to make sure I'm not wrong.
Maybe you should teach my class. Thanks a lot, McKenna.
Sorry, I was just. I was like, am I going nuts?
No. No, I didn't read carefully.
So on that last question, we would have recorded the cost of goods sold. Because the last one was the same thing, but it was perpetual, right?
Yes, if it's perpetual, you record cost of goods sold. If it's periodic, you record cost of goods sold at the end of the month.
Exactly, at the end of the reporting period. Whatever that may be.
By counting inventory.
Yeah, accounting period.
Well,
Okay.
the way it works is there are techniques for estimating
Mm-hmm.
what your inventory is, which is what companies would do like maybe monthly. And then at the end of the year, when they're audited, you also do a full inventory count.
Of everything, yeah.
Yeah, and then you can reconcile any shrinkage. I have no idea why we call missing inventory shrinkage.
Because like with the periodic though, you take all your net purchases minus your sales, like all your sales expenses or whatnot. And then you take your beginning inventory, ending inventory, and then you reconcile that to make sure
Yep.
they match up. And that's what accounts for shrinkage instead of doing an actual, right? An
You
actual
should
entry report.
You should teach my class.
I just want to make sure I'm getting it right.
You've got it. You're
Okay.
nailing it. In fact, what you just said, by the way, do you prefer Christopher or Chris?
Either one.
Okay, what you just said is exactly what you're going to need to know in managerial accounting also.
Okay.
Like that's a huge, big piece of it. So well done.
Okay, thank you.
All right, now we're going to look at what net income looks like with all of these allowances and discounts and everything. So we're going to do net income. Oh, this should be 245,000. Okay, so Cushman Company had $900,000 in sales. All right, we know that that's obviously part of net income, right? Sales discounts of 15,000. We're going to subtract the discounts from the sales to get to net income. Sales returns and allowances, we're going to subtract those. And if you were looking at a real income statement, you would see either sales less sales returns and allowances and sales discounts, or you might see that it says net sales. And when it says net sales, this is why. It's taking into account these adjustments. Cost of goods sold. We know that we have to subtract cost of goods sold to get to net income. So we're going to subtract 400,000. And we have to subtract operating expenses. So we're going to subtract 245,000. So when we're all done, net income is 230,000. This one's pretty straightforward. Are we good with this one?
Mm-hmm.
Okay. Okay, now we're going to, look at what's wrong and reconcile it. So there's something really weird about this question. So Bedrock Company reported, what we're trying to do is we're trying to do the correct, what we want is the correct balance for ending inventory, okay? So Bedrock Company reported a December 31st ending inventory balance of 415,500. So we're going to start with that, and then we're going to figure out what we need to fix. This is the part that, this one's the one that's weird. The ending inventory balance of $415,500 included $73,900 of consigned inventory, for which Bedrock was the consignor. Okay, so when a company that has consigned goods that they're selling means that, like you'll see antique stores like this, that inventory in there doesn't belong to them. It belongs to the customer that put it in the store. However, there's the consignor and the consignee. The consignor is the one that owns the inventory. If it said consignee, then they do not own the inventory. So in this case, the reason I say it's really weird is because they're asking it in a way that, to me, it would normally be, well, they want us to subtract the consigned goods because they're not part of inventory. But we don't subtract the consigned goods here because we're talking about the consignor, so he actually owns them. But what we do have to do is that the ending inventory balance has $25,800 of office supplies included in it. Our office supply is part of inventory. Now, are we going to sell them?
No.
No, it's only part of inventory if we're going to sell them to somebody, which we're not. So we have to subtract the office supplies because they're not part of inventory. They were incorrectly recorded there. So we have a total of $389,700. Are we good there?
Mm-hmm.
Oh, inventory. Yes. I love inventory.
Hmm.
I don't know why. I loved inventory back in college. I loved inventory and dividends. I still remember working inventory and dividends. I love them. Okay, so the first thing, so in January, all right, so this is using perpetual. So, and we want to figure out, so on December 31st, there were 30 units remaining in ending inventory. We want to use the perpetual and LIFO, last in, first out. And remember, this is, when you look at LIFO and FIFO, that is not physical. It's not talking about the physical flow of the inventory. It's only talking about how we're going to assume that the costs are set up. Does that make sense? It has nothing to do with physical. All right, so, and we can see here with the 30 that we had 72 units available. We sold 42. So 72 units available minus 42 sold means that we have 30 in ending inventory. All right, now this one's more complicated than any of the other ones. Here's what we have to do because we're doing last in, first out, and it's perpetual. And we had sales all during the period. So what we're going to do is, first of all, we're doing ending inventory. So last in, first out. So we're going to start taking from the bottom. So is our ending inventory at the top or at the bottom?
The bottom.
Nope, we start taking from the bottom. Last in, first out. So we're going to go this order. So up here is our ending inventory actually starts at the top and works its way down, which I'm just going to keep telling you guys. All right, so for January, we had 11 units. We sold 5 of them. So that's 6 units at $145 a unit. And then in the second group here, we had 21 units and we sold 6. So that gives me 15 units left at 150. And then we had 16 units and we sold 10. So that means we have 6 left at 155. And here we started with 13 units and we sold 9, which means we have 4 left at 160. And then the last row, we had 11 units. Oh, we don't do the last one. We're going to say, here we have 15, 19, calculator. I think we have 3 left. 6 plus 15 plus 6 plus 4. Wait, that's already 31. Six plus 15 plus 6 plus 4. Cost of ending inventory. So we actually are going to have to stop at 3 here to get to 30 for ending inventory. So that means that we're going to say 6 times 145 is 870. 15 times 150 is 2,250. 155 times 6 is 930. And the last one is 3 times 160 gives us 480. So ending inventory, 870 plus 2250 plus 930 plus 480. All the other ones are easier. 480. So ending inventory is 4,530. Next ones are easier. There's the mouse. Oh, and pictures are really... Okay, so this one is still using perpetual, but this is what I meant by the quiz is easier than the homework because what?
I got a question.
Okay.
So on the last one,
Mm-hmm.
So we have 30 units that are worth 4,530, right?
Right.
So, but this is on LIFO. Wouldn't it be better to use the weighted average?
No, because we were told to use LIFO.
Okay.
Okay, so these are easier
How are we gonna determine the prices of each unit?
because they give it to us.
Okay.
Just like here, they give it to us also. They're always going to give it to us. What we have to do is figure out what total cost we're going to assign.
Okay.
So like this one, let's say this was LIFO. Last in, first out. And we want to know cost of goods sold. So this is still perpetual, but we don't have a problem with the layers because all we have is purchase, and we know how many units were sold. So we know 22 units are sold. So last in, first out. So if we're trying to figure out cost of goods sold, last in, first out, do I start on the bottom and work my way up or the top and work my way down? Last in, first out. So, and I'm doing cost of goods sold. So that's the units we're taking out. Do I start from the bottom or the top?
Bottom.
The bottom, because that's where the last units that came in are. So you're going to start from the bottom and work your way up. So I had 22 units that were sold. So I'm going to take 22 of these 25 because I have to start at the bottom. So it's 286. Now, let's say instead that we were doing FIFO. Now, first in, first out. So where do I start? At the top or at the bottom?
You start from the top.
I'm going to start from the top and work my way down. So now I'm going to take 20 of these. So we have 220. But then I need 2 more units because I'm trying to get to 22. So I'm going to take 2 of this next group. So 2 at $13. So using FIFO, my cost of goods sold is 246. Make sense? And that's why even though it's perpetual, it's not as hard. Okay, now we're going to figure out cost of goods sold. So with this one, you have to build your own table, which is fine. So you have to build your own table. So we know that we had inventory 30 units. So our beginning inventory was 30 units at a cost of $10 each. On August 3rd, it purchased 40 units at $11 each. So we have our purchase of 40 units at $11. Then 25 units are sold on August 6th. We're not going to put that in our table. August 6th, and the reason we aren't is because everything that was purchased was before that. So even though it's perpetual, these are the only layers we have. So if we sold 25 units and we want to do cost of goods sold, that's the number of units that we're concerned with. This is supposed to be 25. Okay, so we're using FIFO. So first in, first out. And we want to do cost of goods sold. So first in, first out. for cost of goods sold, do I start at the top or the bottom? Top. Yep. So I'm going to go top down for cost of goods sold. So I need 25. So I'm going to take 25 from the top row. And that's all I need. So I can do 25 at $10 is 250. Are you good there?
Yes.
All right, this next one's super easy. Let's say that you have inventory on your balance sheet. It's usually a significant cost on your balance sheet or a significant asset, right? So we have a rule called looking at lower of cost or market. And for this purpose, market equals replacement cost. So the idea behind lower of cost or market is you don't want to have more, you don't want to have your inventory on your balance sheet worth more than what it would cost if you went out and replaced it, because that means it's overvalued. So we're going to look at the difference between cost and market. So a company's normal selling price for its product is $20 per unit. The selling price doesn't matter. However, due to market competition, the selling price has fallen to $15 per unit. The company's current inventory consists of 300 units purchased at $16 per unit. So the cost on our books right now, those 300 units are recorded at $16 each. The problem is the replacement cost has fallen to $13. So the market rate is $13. So we want to know the value of the company's inventory. The value should be the 300 units times $13, which is 3,900, because we're going to do lower of cost or market. Oh, yay, inventory. All right, are we good here? All right, so we have to draw our inventory table again here. So a company had beginning inventory of 15 units at $20 each on March 1st. On March 2nd, they purchased 10 units at $25 each. On March 6th, they purchased 5 units at $22. On March 8th, we sold 26 units. Using first in, first out and perpetual, which again isn't a problem because there were no sales in the middle of the month. It's at the end. We want to know what was the cost of the 26 units sold. So we're doing first in, first out, and we're calculating how much cost of goods sold is. So first in, first out. For cost of goods sold, do I start at the top or the bottom? Yep. I'm going to start at the top, first in, and work my way down to the last ones. So I know that I sold 26 units. So top down, I'm going to take all 15 of these. So 15 at $20. It's 300. I need 26. So I need 11 more. So I'm going to take all 10 of these and I'll take one of these. So now I've got 10 units at $25 for 250. And I have one unit at $22 for $22. So my cost of goods sold is 572. Getting the hang of inventory?
Yep.
Okay, this next one has to do with reconciling a cash register. And there's just something quick I need to teach you. So there's a new account, which is really weird, and it's called cash short or over. And the weird thing about this account is that it can be a debit or a credit because it's cash short or over. So that means that if I'm short cash, I'm gonna debit it. And if I'm over, like if I count my sales and what's left in my cash register drawer, and I'm over, then I'll go ahead and credit it. So we're going to record our sales in the cash. Ideally, they'd be the same. So at the end of the day, the cash register's records show 1,158. Okay, so we know that this is the sales because that's what the cash register says. But when we count the cash, we only have $1,149. So we're going to record the cash because that's what we have. We can't record more than we have. So 1,149. We're going to record the sales of 1,158. So we're $9 short because we should have 1,158, but we do have 1,149. So this is cash short or over. So that you're able to record your cash and you're able to record your sales. All right, are you good there?
Mm-hmm.
Okay, so this is petty cash, and I have a video on petty cash. So petty cash is interesting because you debit the petty cash account and credit cash when you set it up. But after you set it up, you never touch the petty cash account again. Everything is cash. So what you would do is, like here we have this company keeps a $450 petty cash fund. And right now it has $59.50 in coins and currency, plus $385 in receipts. So basically, we want to replenish the petty cash fund. So we have a petty cash fund of $450. And we have in that box $59.50 in coins. Yes. $390.50. Okay, so in order to get back to $450, we need that doesn't make any sense. in order to get back to $450, when we only have $59.50 in there, we need to get money. We need cash equal to $390.50. Now, what we would normally do is we're going to record our expenses. And I'm going to say various expenses, but you wouldn't do that. You would record each one, like meals and entertainment, fuel, whatever. But I don't have the detail. So I have $385 in receipts. So I'm going to record those as expenses. I have to write a check to cash for $390.50 so that my balance in my box is $450. So my difference is $5.50. So once I've done that, I've gone to the bank. I wrote a check for $390.50. I came back. I recorded the receipts as expenses. I put that $390.50 in my petty cash box where I already have $59.50. And now I'm back up to $450 that I can spend. Okay. Okay.
I have a question. Maybe this is something that we cover at closer to the end or a different course entirely, but what happens to that difference in the money? It was $9 on the last one and now another $450. So where's that money? How do we make that up?
Well, here you're probably missing a receipt, right?
Okay.
We would have recorded an expense, but we're probably missing a receipt. But no, the other, when you have like a cash register, they have a margin of error, but what happens is if it becomes a pattern, somebody loses their job.
Okay. Hopefully it wasn't the same person that lost the money.
Exactly. Like I said, if it becomes a pattern, I had a friend that owned a health club, and they had this employee that whenever that employee worked, at this club, it was a small club, and they would pay like their monthly dues at the front desk, some people. And whenever a certain person worked on Saturdays, they started realizing that you were significantly, the same amount of money that normally came in from customers didn't come in. And they realized that they were stealing from them. You hear about big, huge fraud cases, but in reality, it's not the big, huge fraud cases that are a problem. It's the fraud and the theft at small businesses, because a larger business can more often absorb the loss, whereas a small business, somebody steals $10,000, that can be a lot of money. The reason to know something about accounting, even if you don't want to do it, if you want to have your own business. Okay, bank reconciliation. There's a video on bank reconciliations, but this one I wanted to show you because this is an error, and errors are a pain in the neck because they can always go either way. The bank could make an error. By the way, I used to think they'd never make mistakes, but then some of you aren't old enough to remember, but all the banks were like merging and stuff. And the company I worked at, our bank was switched over to Wells Fargo, and 3 months in a row during the transition, I was reconciling the bank statement. The first time, I thought it must be me, like maybe I'm coming down with the flu or something, because I couldn't get it to reconcile. And finally, I pulled out all the checks, and the bank had made errors, and that happened 3 months in a row. So it can happen. The trick to figuring out errors. The trick for figuring out errors is to figure out what is it? What is on our books? What should it be, and what's the difference? And then you have to figure out, is the bank correct or are my books correct? So here's the thought process. If a check correctly written and paid by the bank for $416, okay, so I'm thinking right away, okay, so I know that the correct amount is $416. That's correct. And that's the bank. The bank is correct. But we recorded it on the company's books for 461. So we recorded 461. So the difference is $45. Now you have to think, okay, am I high or am I low? Well, I deducted $461 on my books, but I should have deducted $415. So I deducted $45 too much. So if I deducted too much from cash, I need to put it back. So I need to increase cash $45 on my books, not the bank. So that's the thought process for an error, because they're always different and it can go either way. So you really have to be able to think through errors. Fortunately, they don't happen too often. Are we good here? Okay. Along the same lines here, now we're going to talk about, we want to know in preparing the July bank reconciliation. So we're talking about a bank reconciliation and we're looking at what should the company do. So during the month of July, Clanton Industries issued a check in the amount of $712 to a supplier account. The check did not clear the bank during July. In preparing the July 31st bank reconciliation, so what this is called is an outstanding check. And what an outstanding check means is that when the company wrote the check, made the payment, they deducted the $712 from the books. But if the other company hasn't deposited it, or if there was a timing, like the last of the month issue, it doesn't show up on the bank statement. So according to our bank balance, we didn't get that check. So to reconcile our bank statement, we didn't write the check. Our book balance is correct. On the bank balance, we need to deduct the amount of the check because we've already deducted it on our books. Remember, everything about a bank reconciliation is just timing differences between what we do on our books and when the bank knows about it, and vice versa. That's all bank reconciliations are. And by the way, I know that most people don't do them at home anymore, but companies still do them. And you do have to prepare a bank reconciliation, but it's a pretty simple one. There's one in the homework. This will take you back a little bit. So interest accrued, you want to record interest accrued on 7,200 at 7% for 45 days. So you have to remember the formula, principal times rate times time. So our principal is $7,200. Our rate is 7%. And the time is 45 out of 360. Do you know why we use 360? Did I tell you guys why? I didn't know either for a long time. I just do what I'm told. And then I was teaching a graduate class and I had somebody that had their degree in finance and they decided to sit for the CPA exam. and he brought it up. And it's because, you know how we don't, when we're doing this, we don't figure, okay, December has 31 days and, you know, January has 30. We don't care about that. So if you took 30, an average of 30 days out of the month times 12, you get 360. That's why they use 360 days.
Yeah.
See, you don't even have to wait to be teaching graduate school for 3 or 4 years to learn that. All right, new topic. This is one that we didn't talk about, but there's videos. Accounts receivable. So we have that new account, remember? So the idea with accounts receivable is we're not going to collect everything that we're owed. We just aren't. And so accounts receivable is a large balance on our balance sheet. And so we're overstating our assets and our sales if we don't recognize uncollectible accounts. So in this case, Gideon Company uses the allowance method. That just means that we record the allowance for doubtful accounts during the same period that we made the sale. Sometimes you'll hear this called allowance for uncollectible accounts, or you might hear it called allowance for bad debts, anything like that. The other side of this is bad debt expense. So when we estimate how much won't be collectible, then we record bad debt expense and the allowance for doubtful accounts. So the bad debt expense goes on the income statement. You have sales and your bad debt expense kind of reduces the sale for the amount that we're not going to collect. The allowance for doubtful accounts is another contra account. And this would be a contra asset account because it goes with accounts receivable, because we have accounts receivable less allowance for doubtful accounts. Now, here's the funny thing though. When we record, this is to not confuse you, this is before what we're doing here. So before we recorded bad debt expense for our estimate, don't know what that was, and allowance for doubtful accounts. That's what we did when we estimated what would be uncollectible. But now what's happening is now we're actually writing off a specific account. We're writing off a specific account. We can't record bad debt expense because we already did. We recorded bad debt expense back when we estimated it. So when we write off a specific account, we're going to take it out of the allowance for doubtful accounts. It's almost like, oh, I guess that wasn't one of the ones. We're going to take it out of the allowance for doubtful accounts, and we're going to take it out of accounts receivable. We'll write off the account. But you don't record bad debt expense because you recorded that when you estimated it. Which is kind of interesting. All right, now we're going to look at the two ways of estimating it. So this one, all right, so there's percent of sales and there's percent of receivables. Basically, if you are looking at just sales, you're going to keep adding on to the allowance account. But if you are looking at the whole accounts receivable balance, then you're going to adjust the allowance account. So on December 31st of the current year, the unadjusted trial balance of a company using, so here we say percent of receivables. So if it is if we're looking at percent of receivables, you are going to adjust the allowance account. If it's the percent of sales, then you're just going to add onto the allowance account. Now this one is the percent of receivables. So we know we're going to adjust the allowance account. So I have, here's my allowance account. All right, so accounts receivable had a debit balance of 99,100 and the allowance for doubtful accounts had a credit balance of 1,151. What amount should be debited to bad debt expense, assuming 6% of outstanding accounts receivable won't be collectible? So I know that I have $99,100 in accounts receivable. And if I'm going to estimate that 6% won't be collectible, then I'm going to estimate that $5,946 won't be collectible. So what that tells me is that I want this balance to be 5,946. So the question is, my expense is what does it take to get from the 1,151 that's there right now to the 5,946. So I have to add $47.95. That's my bad debt expense that I'm estimating. Because when I record that, my allowance account will be $59.46. So when I record bad debt expense and allowance for doubtful accounts, what I've done is now on my income statement, I'll have bad debt expense. And on my balance sheet, my allowance for doubtful accounts will be $59.46. Because when I'm looking at all of the receivables, which is the 99,100, I think that my total for my allowance account should be 5,946. We're going to do another one like it, and I'm going to show you where they're going to try to trick you up. So the normal balance in the allowance account is a credit because it's a contra asset account. So the normal balance is a credit. So in this one, a company ages its accounts receivable. Okay, so again, we're looking at all of accounts receivable, which means we're going to adjust the allowance account. Okay, so a company ages its accounts receivable to determine its end of period adjustment for bad debts. At the end of the current year, management estimates that the accounts receivable balance will be 24,000. Oh, I'm sorry. That the uncollectible portion of the accounts receivable balance is 24,750. So the nice thing about that is when we're looking at our allowance account, what they just told us is that we expect the balance to be 24,750 because that's what isn't collectible. Prior to any year-end adjustments, the allowance for doubtful accounts had a debit balance of 675. Now, this is the normal. Credit is normal. So in order to finish this, now I'm saying, okay, I want my balance to be 24,750. So in order to get there, I have to credit this 25,425. So I'm going to record bad debt expense and my allowance for 25,425. Because when I've done this, since I'm looking at the entire accounts receivable balance, when I've done this, on my income statement, I'll have bad debt expense. And on my balance sheet, my allowance account will be 24,750. All right, next one's easy. So on this next one, it was too long to write here. You're going to have this problem where you're going to percentage of sales method. So for this method, do not adjust the allowance account. Instead, what you have is your sales amount times whatever the percentage is what your bad debt expense is. You're just going to keep adding it on. Oh, and we get to practice again. All right, so same situation that we just started. A company has 98,000 outstanding in accounts receivable. And it uses the allowance method to account for uncollectible accounts. Experience suggests that 5% of outstanding receivables will be uncollectible. So we're looking at everything, so we're going to adjust. So if accounts receivable is 98,000 and we think 5% won't be collectible, I have this here. That means that we have $4,900 that we think won't be collectible. So that's the balance we want our allowance account to be. 4,900. The current balance before any adjustments in the allowance account is an $880 credit. All right, so we're starting with 880. So in order to figure out bad debt expense, we want to know what goes here. So I have to credit this $4,020 to make my balance 4,900. So my bad debt expense And my allowance will be 4,020. Oh, the next one's easy. The last one's super easy. So we're just going to record the journal entry for this transaction. So Jasper makes a $77,000 90-day 7% cash loan to Claiborne. That none of the interest or anything else matters. All that matters is he now has a note receivable, and he gave away cash for $77,000. That's it. Okay, don't forget, watch the short videos when you have questions. You can also call me if you have a question. I will post this in the morning. I'm going to walk away and leave it right here so I see it first thing when I get up. Any questions on the paper? No? Okay. Just wanted to make sure.
It's due next week, right?
You could turn it in up to the last day of class,
Okay.
which is technically Saturday, except for we'll call it Sunday.
Okay.
All right. I will see you guys on Tuesday. If you have questions, text me, call me. Text works best because of all the spam calls I'm getting. And I will see you on Tuesday. Good luck. Have a good weekend. All right. Good night.